Hello and welcome back to our channel, Finance with Angelina. Today we are going to talk about the intelligent investor and see how a beginner can get most of it with examples. The Intelligent Investor, the definitive book on value investing by Benjamin Graham and Jason Zweig, is a widely acclaimed book on value investing, which is an investment strategy that targets undervalued stocks of companies that have the capabilities as businesses to perform well in the long run. The book provides strategies on how to successfully use value investing in the stock market, regardless of the industry and with very little attention to the individual company. The book also introduces the concept of Mr. Market, an allegory that personifies the irrationality and groupthink of the stock market. The book consists of 20 chapters, each with a commentary by Jason Zweig, a personal finance columnist for the Wall Street Journal. The chapters cover topics such as investment versus speculation. Graham defines an investment as one that promises safety of principal and a satisfactory return, and a speculation as one that does not meet these criteria. He advises investors to avoid speculating and to adopt a long-term perspective. For example, buying a stock based on a rumor or a hot tip is speculation, while buying a stock based on its fundamentals and valuation is investment. The investor and inflation. Graham warns investors about the dangers of inflation, which erodes the purchasing power of money and reduces the real returns of bonds and stocks. He suggests some ways to protect against inflation, such as investing in real assets, foreign currencies, or inflation index securities. For example, buying gold, Swiss francs, or Treasury inflation-protected securities, TIPS, can help preserve the value of money in times of high inflation. A century of stock market history. Graham reviews the history of the stock market from 1871 to 1971, highlighting the major trends, cycles, booms, and crashes. He shows how the market often deviates from its intrinsic value, creating opportunities for value investors to buy low and sell high. For example, during the Great Depression of 1929 to 1932, the Dow Jones Industrial Average fell by 89%, reaching a low of 41 points. However, by 1954, it had recovered to its pre-crash level of 381 points, and by 1971, it had reached 890 points. General portfolio policy. Graham outlines the general principles of portfolio construction for different types of investors, such as defensive investors, who seek safety and steady income, and enterprising investors, who are willing to devote more time and effort to achieve higher returns. He recommends a minimum of 25% and a maximum of 75% allocation to stocks for both types of investors, and suggests some criteria for stock selection based on quality, diversification, and margin of safety. For example, a defensive investor could allocate 50% of their portfolio to high-grade bonds and 50% to large-cap stocks that have a long record of profitability and dividend payments. An enterprising investor could allocate 75% of their portfolio to undervalued or neglected stocks that meet certain criteria such as low price-to-earnings ratio or high dividend yield. The defensive investor in common stocks. Graham provides more specific guidelines for the defensive investor to choose common stocks, such as looking for large, prominent, and conservatively financed companies that have a long record of profitable operations and dividend payments. He also advises the defensive investor to avoid IPOs, foreign stocks, and low-priced stocks. For example, a defensive investor could buy shares of companies such as Alphabet Incorporated, GOOG, Pfizer Incorporated, PFE, Johnson & Johnson, J&J, or JP Morgan Chase & Company, JPM, which are well-established leaders in their respective industries with strong balance sheets and consistent earnings growth. The defensive investor in bonds. Graham discusses the role of bonds in a defensive investor's portfolio, emphasizing the importance of quality, maturity, and diversification. He explains the different types of bonds, such as corporate, municipal, government, convertible, and foreign bonds, and their respective risks and returns. He also warns against chasing high yields or buying bonds at inflated prices. Portfolio policy for the enterprising investor. Graham describes the portfolio policy for the enterprising investor, who seeks to beat the market by finding undervalued or neglected stocks. He identifies several categories of such stocks, such as bargain issues, stocks that sell for less than their net current asset value, special situations, stocks that are affected by corporate events such as mergers, spin-offs, or reorganizations, growth stocks, stocks that have above-average earnings growth, and contrarian stocks, stocks that are unpopular or out of favor with the market. For example, an enterprising investor could buy shares of companies such as Wells Fargo and Company, WFC, Verizon Communications Incorporated, VZ, BP plc, BP, or LyondellBasell Industries NV, LYB, which are trading at low valuations compared to their peers or their historical averages. The investor and market fluctuations. Graham explains how the investor should deal with market fluctuations, which are inevitable and unpredictable. He advises the investor to ignore short-term price movements and focus on the underlying value of the business. He also introduces the concept of Mr. Market, an imaginary partner who offers to buy or sell shares every day at different prices. Graham suggests that the investor should take advantage of Mr. Market's mood swings by buying when he is pessimistic and selling when he is optimistic. For example, during the COVID-19 pandemic in March 2020, the stock market plunged due to fear and uncertainty. However, this also created an opportunity for value investors to buy quality stocks at bargain prices. Investing in investment funds. Graham discusses the pros and cons of investing in investment funds, such as mutual funds, index funds, exchange-traded funds, ETFs, closed-end funds, and hedge funds. He compares their performance, their fees, their diversification benefits, and their tax implications. He cautions the investor against relying on past performance or star ratings of funds, and recommends doing some research before choosing a fund. For example, an investor who wants to invest in a diversified portfolio of value stocks could consider buying an index fund or an ETF that tracks a value index, such as the S&P 500 Value Index or the Russell 1000 Value Index. Alternatively, they could look for an actively managed mutual fund or a closed-end fund that follows a value investing strategy and has a low expense ratio and a consistent track record. The investor and his advisors. Graham examines the role of advisors in helping the investor make informed decisions. He distinguishes between financial analysts, who provide objective information and analysis, financial advisors, who provide personalized advice and recommendations, and financial planners, who provide comprehensive financial planning and guidance. He advises the investor to choose an advisor who is competent, honest, and independent, and to avoid those who are biased, incompetent, or dishonest. He also suggests some questions to ask an advisor before hiring him or her. For example, an investor who needs help with their investment portfolio could ask an advisor about their qualifications, experience, fees, services, investment philosophy, performance history, conflicts of interest, and references. Security analysis for the lay investor. Graham explains the basic principles of security analysis, which is the process of evaluating the intrinsic value of a security based on its fundamentals. He covers topics such as earnings, dividends, assets, liabilities, growth, and valuation. He also discusses the difference between qualitative and quantitative analysis, and between common stock and preferred stock. The concept of margin of safety. Graham introduces the concept of margin of safety, which is the difference between the intrinsic value of a security and its market price. He argues that the margin of safety is the key to successful investing, as it provides a cushion against errors in calculation or adverse market conditions. He recommends that the investor should always seek a large margin of safety when buying a security, and avoid paying too much for a security based on optimistic expectations or projections. For example, if an investor estimates that a stock's intrinsic value is $50 per share based on its fundamentals and growth potential, but it is trading at $40 per share in the market due to temporary factors such as negative news or sentiment, then the investor has a margin of safety of 20%, $10/$50. This means that the investor can buy the stock at a 20% discount to its true value and enjoy a higher return if the market price converges to the intrinsic value over time. The book also contains appendices that provide additional information on topics such as accounting, taxation, inflation, and market history. A beginner can get the most out of this book by reading it carefully and applying its principles to their own investment decisions. The book is not a recipe for instant success, but a guide for long-term wealth creation. The book teaches the investor how to think independently, rationally, and patiently, and how to avoid common pitfalls and mistakes. The book also encourages the investor to learn from their own experience and from other successful investors, such as Warren Buffett, who wrote the preface to the book and described it as by far the best book on investing ever written. That's for all in this video. Hope you liked it. If you have any book suggestion, then do let us know in the comments, and don't forget to like, share and subscribe our channel. Have a good day, love you.